afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 20th of September. I'm Brian Fernandez together with my co-host Jeffrey Halley. Now let's take a look and see at the summary of market action today. We'll start with overnight in the US. All three major indexes ended higher with the Dow Jones Industrial Average rising 1.26% to close at 42,025.19, crossing the 42,000 threshold for the first time. The S&P 500 added 1.7% to end at 5,713.64, topping 5,700 for the first time. The Nasdaq Composite surged 2.51% to finish at 18,013.98. Now, the three major averages are on pace for weekly gains, with the S&P 500 up nearly 1.6% through Thursday's close. The Dow is toting a 1.5% jump on the week, while the Nasdaq is outperforming with a 1.9 advance. Now, Asia Pacific markets opened higher today, with Japan's Nikkei 225 leading the gains after Wall Street soared overnight following the Federal Reserve's outside rate cut. Japan's core consumer price index climbed 2.8% year-on-year, in line with Reuters estimates, versus a 2.7% rise in the previous month. Now, this excluding food and energy, the inflation figure was only 2% versus 1.9% in the previous month. Now, the Bank of Japan kept its benchmark interest rate steady at 0.25%, the highest rate since 2008, at the conclusion of a two-day meeting this morning. Now, the Japanese yen firmed against the greenback. China also did not tinker with its key lending rates, with a one-year loan prime rate, which affects corporate and most household loans, at 3.35%, and the five-year loan prime rate, a reference for mortgage rates, at 3.85%. Now, let's take a look at how markets across the region are performing. Jeff, over to you.
Okay, it's a mostly positive day for Asian markets after the Bank of Japan and China held rates steady. There are a couple of notable exceptions. In Australia, the ASX 200 is up 0.36% on the day. South Korea's Kospi has climbed 0.99%, with the Nikkei 225 leading the way, up 2.04%. Hong Kong has also liked those rate decisions. The Hang Seng has risen by 1.27%. But in Shanghai, the Shanghai Composite has slipped 0.32%. And Singapore is also a little bit lower on the day, down 0.47%. Bringing up, finally, the Kuala Lumpur KLCI is up 0.42% as it eases into the weekend. And now let's bring in today's guest to perhaps digest all of these movements in the market. I'd like to welcome Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, as ever, welcome to the show.
Thank you for the invitation, and happy Friday, Jeff and Brian as well.
Kelvin, we've got to start by kind of getting your take on markets today.
Sure.
What's your view on price action?
What I would say that if you digest it from a two-day perspective, it's a rather a wild ride. Yeah? So what's interesting over here is right after the U.S. Federal Reserve press conference, we see a dramatic sell-off in the major U.S. stock indices overnight. So in fact, all the major U.S. stock indices ended in the red. The Dow Jones, the Russell, the Dow Jones, the Nasdaq, the S&P 500, the Russell 2000 was unchanged. And what's surprisingly is that yesterday's Asia session, we see a significant rally in the S&P and the Nasdaq futures. So that's during the Asia session, right before the US normal session opened at 9:30 p.m. Singapore time. And that led a tremendous risk-on rally throughout the globe. Then we start to see the Hang Seng, the Nikkei 225, those larger Southeast Asia benchmark stock indices like the Singapore STI, and spreading throughout the rest of the European major stock indices as well, putting on this bandwagon about extra liquidity that's been added to the global financial market. But I want to take into one, in terms of a relative performance perspective, because to ask ourselves why gold XAU/USD is joining the bandwagon as well. So if it's a throughout so-called all things are good for the global economy, we talk about the Goldilocks scenario. On a relative basis, gold should be actually underperforming right now because we know that gold, if you start to hoard gold, I mean, you don't own anything, right? It's zero interest. So money should actually shift into those asset classes that give us income. We talk about stocks that has a dividend, better dividend yield. But why there is still this appetite in gold right now? That is not, I think, as we are speaking right now, they are seeking to retest the all-time high at 2006 level that was printed right before Jerome Powell press conference. So we got to ask this question over here. Perhaps is it that rally that we see yesterday is a bit far-fetched, that we got to be a bit more concerned, especially if the Fed indeed is late in this particular interest rate cut cycle, even though Jerome Powell actually in a way kind of denied it, and he said that his base case scenario is that US is not into a recession. But if that's the case, why did he opt for a 50 basis point cut? Why not for a 25 basis point cut if he's pretty much confident on the state of the US economy? And if you look back in the past history, there are actually some cycles that the US Fed pivoted from hike to cut. And during that point in time, the US already slipped into a recession. The next 3 to 6 months of the performance of the S&P 500, using that as a gauge of the US stock market, doesn't gel that well in terms of the performance. So something to be aware of here.
Great stuff. Kelvin, let's move away from stocks for a moment. We've had rate decisions now from the Federal Reserve, Bank of England, Japan and China today. US dollar generally looks like it's a little weaker. Can you walk us through what the state of the FX markets are post all of these tier one rate decisions?
Yes, sure. For sure. So let me touch on the Bank of England. So Bank of England, without any surprise, maintained their policy rate unchanged at the 5% mark. So what we could see at a range unchanged. So what we could see over here is that the guidance that coming out from Bank of England is rather very, very cautious. Very different from the Fed. If you look at the Fed statement or Jerome Powell press conference, they have a clear indication that they really defeated heightened inflationary pressure in US. Whereas for Bank of England is on the flip side. They actually keep mentioning about rather strange persistent services side inflation that is still relatively elevated in their opinion. And that could actually potentially kind of ease off the expectation for another interest rate cut in UK. So perhaps this year itself, they only have one interest rate hike by Bank of England, and thereafter they will keep it maintaining at this rate and think about it later at the start of next year. So that actually pressured the US dollar. As we are talking right now, we see the dollar rebound, the initial rebound after Fed Chair Powell press conference totally died off, and we see ongoing weakness of the dollar across the board. And now, Bank of Japan, very interestingly, Bank of Japan, no change as well. For the didn't surprise the market because the market was also expecting Stampede to actually monitor the excess the situation in the global financial market. Why is it important? Because two Bank of Japan key officials, right after that so-called unfortunate interest rate hike by 25 basis point, kickstart that was called very messy unwind. So it's a very messy disruptive movement that caused that global risk-off scenario that took shape on the 5th of August. So they are pretty much monitoring the state of the global economy or the global financial market before deciding what to do next. And what's interesting over here is that in their monetary policy statement, they actually sounded rather confident in the state of the Japanese economy, both on the inflation. So he did mention that this particular statement that saying that inflation expectation heightened moderately. That means, i.e., the Bank of Japan officials are confident that inflation is on their path of stabilizing at 2%, that is excluding fresh food and energy. And also, they did mention that consumption trend rising moderately as well. That means, i.e., consumer behavior is rather positive in Japan. So net overall, it seems to be that setting the stage for at least a potential another 25 basis point hike, not cut by the Bank of Japan before 2024 ends, and that actually responded by the market itself. If we look at the 2-year Japan JGB yield, which is pretty much sensitive to Bank of Japan monetary policy, now it's trading slightly higher at around the 0.39%, slightly above the 25 basis 0.25%, at the overnight policy rate. So indicating that market participants are actually looking for a potential rate hike, at least by another 25 basis points before 2024 ends in Japan.
Kelvin, thanks so much for that insight, comprehensive as ever. And thanks for coming in today. And I wish you a wonderful weekend ahead.
Likewise as well.
This has been BizTech's Asian Midday Market Watch. Be sure to keep informed with the latest market updates on weekdays at 1 p.m. right here on BizTech Asia. I'm Jeffery Halley.
And I'm Brian Fernandez.
And this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It will also be available with our syndication partners, TV stations, radio stations, and websites. Remember to like and subscribe. Thanks for tuning in today.